CNBC TV 18 and India Bonds presents Bond Street.
On Bond Street today, we are joined by a very special guest. We have with us Balasubramanian. He's Managing Director and CEO at Aditya Birla Sun Life Asset Management Company. Bala, hi, thank you so much for joining in. And you've been in fixed income asset as an asset class for a very, very long time, couple of decades or more. And how have you seen bonds or debt market gain in popularity during these years?
Yeah, thank you, Manisha, for having me part of the show. Of course, I've been associated with the bond market since 1992. Immediately after the Harshmata scam, I got into the bond market as money market trader. Then I was a portfolio manager for almost about a decade before I became an equity manager as well. But I'm associated with the bond market 92 since the time the reform period on interest rates, where interest rates were freed and then made it more market-driven kind of interest rates.
So you've lived the bond market journey.
I've lived the entire bond market. I've also seen issuance of bond market at as high as about 25%, where G capital kind of companies who had created a presence in India way back in the 90s had borrowed in India at a very high cost, about 25%, with backstop facility coming from their parent company in the US. Even like Kotak Mahindra Finance in those days used to issue bonds about 7.5 to 18%. So I've lived through that period. And moving away from that to a holistic investor across the yield curve, right from money market instruments to the corporate bond and government securities, central government securities to the state government securities. I have seen the entire cycle with interest rates touching as low as about 5%, interest rate touching as high as about 11.5 to 13%. So I have seen large coupons, which used to be the biggest savior for us as a bond market investor. Higher the coupon, higher the protection for you. Lower the coupon, lower the protection for you from an accrual point of view.
Right.
I've seen this cycle, how it got evolved, how it got developed. But as time progressed, the more and more market became transparent. The money that is available for investing in the bond market through the mutual funds and more players coming in, it has only got more and more vibrant and bigger. Of course, one has to still keep in mind the bigger bond market issuers in the country is the Government of India. Next is the state government issuance of bonds. Then third is the public sector companies. And then fourth is the private sectors and corporates and NBFCs. If you look at that bucket,
right,
and mix between money market instruments to the long-term bond issuances. Even the banks themselves, most of the time, issue bonds by way of infrastructure bond, by way of CDs for 1 year money market instruments. They also issue AT1 bonds. Therefore, they only got developed over a period of time. My belief is it's a large market. And in fact, being part of the bond market, I have seen complete evolution of the bond market in terms of bringing one of the biggest investment vehicle for all of us as a money manager.
So fast forward to 2025, and the last couple of years haven't been so great, but 25 really seems to be changing that. And would you say 26 perhaps could be even better? So if you had to look at the next 4 and 5 years, especially with OBPs now becoming a bigger part, retail perhaps is being pulled in as well, how would you look at India in 2026 and the next 5 years?
I think it can only get better because we are all involved in the bond market development since the 1990s. And every time we used to always think that we keep discussing, but nothing much is happening. But if you look at the progress, like OBP platform that you mentioned about, is a platform created by the industry players to get more and more participation, to see the prices, to the yields, to the prices, to the issuance, to the outstanding, to the volume. With the all of us as a mutual fund players and other institutions now reporting the transactions on OBP platform, definitely the data that is available for one to know better on the bond market is increasing. This will actually create more and more awareness. And second is the SEBI regulated entities like RFQ platform, which has created more for increasing the more trading data points for the bond market players. I think these evaluations will only make it more better. And last but not the least is so far, the last 2-3 years, most of the companies actually who need more capital for growing the business, they always used to debate between equity growth capital versus the bond market. The last 3-4 years the journey has been much better for most of the people for raising money to the equity market. I'm sure the time will come, but they have to come to the bond market for funding their growth. So therefore, the next 4-5 years, if you take, I think after some time people start saying, why should I actually share my wealth beyond a point by way of issuance of equity?
Right.
They will always switch towards the bond market.
And do you see that happening? Do you see that?
I see that happening. Second is actually if I'm net worth is say X amount, but through the bond market, I can go up to 1.5 times of bond market issuance, which is basically the debt equity. If I have to take close to about 1.5 times leverage, I can do. The multiplier effect of that could come for the investors, ROE, the more the growth I build through the bond issuances,
More people
my ROE is better for shareholders' point of view. I think that's what most people start looking at it. I think time will come where companies will start realizing, probably if I fund my growth through the bond market, where the cost of capital today is the lowest, and therefore funding through the debt would become more cheaper than funding through the equity, both from a shareholders' value creation point of view, as well as the money multiplier effect point of view. Therefore, next 4-5 years, I would assume the issuance of bonds will increase. Of course, Government of India has also done a great job of bringing down the fiscal deficit. Therefore, the more and more issuance of government bonds comes down, more and more room will be available for private issuances to come in, which is what I feel the next 4-5 years we'll see. Bond market issuances keeps rising, and that's something would be more ideal, even for any investors to look at that, not ignore that segment. The reason is the return there you see is real, earn, you see it, coupon coming in month on month with an annual basis. Therefore, that's something should not be ignored from a broader perspective.
CNBC TV 18 and India Bonds presents Bond Street.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.